Well, welcome everyone to today's webinar. And as always, we have a great one for you. Very excited to talk about what's been happening throughout the first half of the year in the overall market, in the economy, and where I think we're headed for the remainder of 2026. Appreciate everyone submitting your questions. Definitely helps shape what we're going to discuss, and yeah, got a lot of great questions today. And if we don't happen to cover your exact question, be on the lookout for our next podcast. We like to cover the questions that are submitted on one of our next podcast episodes. All right, well, let's get into it. Let's talk about where we've been for the first half of the year. Here I have a graph of different equity-based benchmarks or indices, as we like to call them in the industry. And these all just represent different baskets of stocks. And you can tell by the colors, there's several of them on here. Best performer for the year is the Russell 2000, up almost 19%. Russell 2000 represents smaller companies in size, whereas the S&P 500, which is the purple line, which is actually second from the bottom, represents more of the largest companies here in the United States. And then the NASDAQ 100, which is primarily tech companies. Not all tech companies, but there's a lot of tech in there, and that's up 11% for the year. Dow up similar with the S&P 500, and then we have emerging markets, which is companies that aren't quite developed yet, so they still say they're emerging. And then we have international, which is international developed, which is the lowest performer. Again, all positive for the year, but you can see definitely a divergence between the different benchmarks here, different indices. Now, taking it to the sector level, now this is the sectors within the S&P 500, and again, a lot of different colors here. There's definitely a clear outperformer, and that's the energy sector, which not necessarily surprising. If you've been filling your vehicle up at the gas pumps, gas prices are high, and that does benefit energy companies. Worst performers for the year, we have communication services, and we have consumer discretionary. We also have healthcare has kind of struggled this year. The financial sector has struggled, but by and large, again, all these different asset classes or these different sectors do different things at different times, and they'll make up the performance for the S&P 500. So you can see how it's been quite the year in terms of a divergence, I would say. Now let's talk about interest rates. Interest rates, we're going to go through our outlook for interest rates and, of course, our outlook for the stock market. I've got these are interest rates for government bonds. So when you loan your money to the U.S. government, they pay you back a rate of interest based on how long you decide to loan your money. So that's the length of time until maturity for your investment here. So purple, which is the highest, is the 10-year treasury. So when you loan your money to the government for 10 years, currently you're looking at 4.65%, 5-year 4.4%, and then the 2-year 4.3%. So not necessarily a big difference between the 2-year government bond and the 10-year, but you can kind of see where those rates are. And then now I've got this broken out a little bit more, and this is the total return for baskets of government bonds. And these are invested vehicles you can invest in, so they represent actual performance. The purple line, which is pretty straight, there's a little bit of variation in there, but fairly straight, represents U.S. government bonds that mature in less than 1 year. And, it's on track. This is as of July 27th, so it's not a little bit more than halfway throughout the year, but on track for over 3% for the year based on where, interest rates are at. And then you can go down the line and kind of look at the different baskets of bonds and the maturity. The longest basket is the 20+ year U.S. Treasury. So when you loan your money for 20+ years, you're actually down on a total return basis for the year. And that's really driven by the fact that interest rates have gone up since the beginning of the year. And that's what the squiggly lines on the chart represent, is when interest rates go down, existing bonds go up in value. So you can see here in February, March, early April, interest rates went down and existing bonds went up. And then as interest rates went back up again, existing bonds went down. And we've been in that trend here for the last, since the end of Q1 primarily. But I'll talk about where I think interest rates are where they're going to go, and what impact will that have on the economy, and what things will impact interest rates, all of the above. So now let's talk about the economy. I like to share economic data and what I consider some of the key economic data points that people should be focused on. First and foremost is the jobs market here in the United States. Extremely important because our economy here is really driven by consumption. It's by individuals, people spending money on goods and services. That's by and large the majority of what drives the economy. Yeah, sure, businesses buy products, they buy inventory, they buy materials, things to make the inventory, but that's a much smaller portion of the overall economy than the actual sale to the end consumer. And then you have government, the U.S. government, which also spends money. And again, that's even smaller than the business side. 70% of it is consumption. The remaining 30% is it's primarily business. You're looking at, a good 20% there, and then the government's pretty much the rest of it. So that's really the makeup. Even though, it can feel like, wow, the government spends a lot of money. They do, but it pales in comparison to what consumers spend. So the reason this is important is because if people have jobs, they have money to spend. When they don't have jobs, they have less money to spend. So we want to make sure people have jobs, and we want to look at the direction of the jobs market. And it's positive. It's still positive. It's definitely slowed over the last several quarters, but has been trending higher in the most couple of releases. There was a negative job release in there, but it is not that big relative to what we've seen in the past in terms of negative layoffs overall, but positive job creation for the most part. This is job openings. So again, important too, because this tells us, well, if businesses don't have a lot of job openings, then there's not a lot of hiring happening. And then there's also probably more layoffs that are likely. Job openings have actually increased over the last few months relative to where they were at the end of 2025. Not quite at the peak post-COVID, but really getting back to where it was at the peak pre-COVID. And I think that's a healthy sign to see this job openings. Now, we don't want it to be too high, because then that means we don't have enough workers to fill the jobs, and that can create other problems. But a good healthy mix between job openings is good. Now, this is another chart related to the jobs market. This is when people get laid off and then they file for unemployment. And this is, this is continued claims. This means these are people that are on more longer term unemployment. So they have to actively be looking for a job to qualify for unemployment. So that's one of the things. You can't just say, well, I got laid off, I'm just going to collect unemployment until it runs out. No, you have to be looking for another job to be able to be eligible. And our most recent data point here is right at that 1.8 million. And the reason I point out these other ones is to show, well, where was it pre-COVID? 1.8, I mean, right in line where it was pre-COVID. Now we had this crazy spike here in the middle of it because of COVID, which 23.1 million people filing for unemployment. I hope we never see anything like that again. Who knows? Most likely not. We've never seen anything like it prior to COVID, and we're back to, I would say, normal. And again, this is another indicator. If we start to see this number trend higher, it's not just one data point; it's a trend over time. That's a warning sign that, okay, if people, more and more people are on unemployment for longer periods of time, that must mean it's getting more and more difficult to find a job. And again, less money for people to spend, which less revenue for businesses, which is less earnings for those businesses too. Retail sales have been phenomenal, and they continue to do so. Something we closely monitor just to ensure that's headed in the right direction. Building permits, so this is for new housing, and that has definitely slowed down. There's a little bit of peak post-COVID. I would say if you kind of look at the trend line, it's probably a little bit lower than where the trend line is coming out of the 08-09 recovery, but it's been not dropping off a cliff either. It's just been slow. Not necessarily a big red flag or something to be overly concerned about. But again, a source of jobs. If housing is slow, that definitely does slow down those areas of the economy. This is business spending, and it has been on a tear. I mean, just look at this since really mid-2005. Businesses have really ramped up their spending, and I'll talk through what they're spending it on, and how we're evaluating that. But businesses are spending a lot of money. And then the last chart that I always like to show is the yield curve. So this is the difference between the 10-year Treasury and the 3-month T-bill. So they're both government bonds. It's just anything longer than a year to maturity is called a Treasury bond. A Treasury bill matures less than a year. When the 3-month T-bill yields more than the 10-year bond, that is when that's what these circles represent. But that's this zero line here. Not quite dark, but it's right here in the middle. Anything below zero is when we call that an inverted yield curve. You're getting a higher interest rate for locking up money on a shorter term basis than you are for locking up money on a long-term basis. Where, many folks probably remember this in the early 80s, interest rates were a lot higher, and people would tell us mortgages were double digits plus. Right now they're at 6, 7%, maybe in the 5s, depending earlier this year. But you're looking at, call it 6% for a mortgage, and so many clients tell us, well, I remember when it was 12, and that was in the early 80s. Well, back then we also had an inverted yield curve. That's this first one, and it was, you could get 10% on a 30-year government guaranteed bond, but you could put it in money market and get 15. So no one wanted the 10% 30-year bonds. they all put it in money market. Now that didn't last very long. Interest rates normalized pretty quickly, but it was something that existed. The reason I show this is because it is a precursor, or can be, historically has been a very good indicator of upcoming recessions. When the yield curve inverts and then starts to go back positive again, you generally see a recession. Now, not all recessions are created equal. Some are, we would say minor recessions. Others are, very significant and deep. There was a ton of discussion about the inverted yield curve really coming out of the 2008, 2009 started to happen. You can see here around 2015. Pre-COVID, it started to go back up again. Of course, we had the COVID recession, which really, the inverted yield curve didn't predict it. And then it was starting to get back to normal again. And then post 2022, interest rates rose again, and we're coming back out of it. But the Federal Reserve's been actively involved in the bond market and yields since 2008, 2009. And I think we're going to talk less and less about the inverted yield curve as being a thing because of that. When it's not controlled by or getting manipulated is not the right word, because they are they're transparent to an extent, but they are transparent. When this was happening, that they were out there buying bonds and to keep interest rates low, so artificially low. So when the market, the free market, as free as it can be, isn't able to control interest rates as it should, well, then some of the data you receive from that can't be relied on the same way as you could historically. Now let's talk through earnings. Again, a very important piece to what's been happening this year, and also what we see going forward. Earnings are what drives stock prices. Stock prices are a function of earnings. And, I've said this through many webinars and even said it earlier today. I mean, it's people have jobs, they spend money, that money that's spent shows up as revenue to businesses. Then businesses pay all their bills, pay their taxes, and then what's left is their earnings. And here's earnings. This is earnings for the S&P 500. So again, it's for that big benchmark index that represents some of the largest companies, big baskets of stocks, a very good representation for the economy as a whole, because we're seeing earnings perform very well. I mean, here's an actual full year earnings. So in 2024, roughly $243. That's in the books. That's not changing. 2025, again, in the books, $274. 2026, the estimate's $342. And then in 2027, $400. Those are significant increases. Now, these are estimates. They're not, it's based on analysts and what they think and what companies are guiding out to the public, because they release quarterly reports and they release guidance to indicate where they think earnings are going to land and what they're seeing. That's what all these estimates are based on. And then we get actual results and update that. So you can see in this graph here, dark bars are actual results. All the dashed bars are all estimates. But it is earnings. Expectations are high, but it's been performing too. It's been actual. So not surprising when we see that. And then we have what we've had in the past quarter with the markets. In Q2, market performance was phenomenal. Now let's talk about where the market multiples are. So this is the other piece of the equation, because earnings, you don't just, if earnings show up at $342 a share, well, then there's a multiple. People are willing to pay, investors are willing to pay a multiple up for those earnings. And if the multiple was 10, you'd just take 10 times $342, and that would give you an estimated value of the S&P 500 of 3,400. Well, the multiple is much higher than that. It's been around 20 for the last decade. And, you know, again, people that are paying close attention to markets and multiples, that has been considered high, but it's been that way for so long that I don't think it's probably considered high anymore. And things that are driving that, well, people have more access to information than they ever had. When information is hard to come by, or when when you're unsure, then multiples generally should be less because you have less transparency, less clarity. I mean, again, it's not that anything's guaranteed by any means. It's just you go back 20, 30, 40, 50 years, well, corporations and who had access to the corporations? Well, it was a few people and analysts, and they would write reports and write research. It wasn't disseminated to the public as easily as things are now. Now you get updates 24/7, as much as you want. You can get updates online on anything. Yeah, sure, you still might have to pay for certain things, but you're getting access to information. And that is, I think, driven multiples higher. I think that's one of the reasons. This is 18x or 18 times earnings, and then up to 24. That's where the range has been for many years. 18 on the low end, 24 on the high end. So here's what I've done. This is how I come up with our range of value, I guess, for the S&P 500 over the next 12 months. So I added up this quarter's estimated, we got Q2. It's not Q2 is complete, but the earnings haven't been released yet for all the companies. So here's the Q2 estimate for 2026, Q3, Q4, and then Q1 2027. These are all estimates. If we add those all together, we get $357 per share within the S&P 500. And the reason I'm looking out 12 months is because the market is looking ahead. It's discounting the next 12 months of earnings. And so as we get closer and closer to 12 months from now, assuming the analysts were right with their estimates, these estimates will change. That is 100% given. They're not set in stone. They will change those. And markets will react to all of that information. But as we stand today, these are where estimates are at. And if we apply this range of multiples, we get forward-looking targets for the S&P 500. So on the low end, if things are performing poorly, if the economy is getting weaker, people are getting laid off, inflation's not cooperating, all of the above, like kind of, I wouldn't say worst case scenario, but if just things are not good, we see a potential drop in the S&P 500, which correlates to the overall stock market of 13% down to 6,400. And if things perform well, we could see on the high side 8,500 on the S&P 500, which is a gain of 15.5% over the next 12 months. Now, this is based on July 27th's closing value for the S&P 500, just FYI. That's what that's based on. So this range has been similar over the last few quarters. Call it plus or minus 15%, but things keep performing well, and so the market keeps going up, and earnings are going up, and earnings estimates are going up. So things have been headed in the right direction. Now let's talk about interest rates. So right now, this is interest rates. This is the interest rate that the Federal Reserve controls, which is the overnight lending rate. It's what, when institutions go to the Fed and need a loan, that's what they charge. Everything else is keys off this, but the Fed, besides what they are indicating with their open market operations where they're out there doing their quantitative easing or quantitative tightening, meaning they're actively buying or selling bonds to adjust interest rates. They don't do that very often, and that's not necessarily a big part of it, but it is something they've done, in the more recent past. Less and less of it so now. The rest of interest rates are driven by supply and demand. So when investors want bonds, that means demand is high, interest rates tend to come down a little bit. And when investors don't want bonds or specific types of bonds or bonds of specific businesses, if they're selling them or not wanting them, no one's buying them, then interest rates tend to go up to where they, until they get to a point to where it attracts people. That's how interest rates work. When you are going to the bank and putting money in money market or investing or buying a CD, generally it does all key off this Federal Reserve rate. And that's, so when I talk about the Federal Reserve and interest rates, it's all about that short-term lending rate here. Right now, they're at 3.5 to 3.75. It fluctuates each day. That's why there's a range there. By year end, the market is anticipating that the Federal Reserve is going to increase rates 1 to 2 times. So 3.75 would be a 1 up to 4.25. Again, that's that range, because 3.75 to 4 would be 1 interest rate increase. 4 to 4.25 would be 2 interest rate increases. And that's where investors, that's what they're expecting. So that would not be a surprise. When the Federal Reserve does things that no one's expecting, that's when interest rates have a big impact on the market, definitely a big impact on bond prices and, of course, yields. So that's where investors are at right now. And the Fed just met earlier this week and kept interest rates the same, which is in line with where expectations have been. All right, so let's talk about what's ahead. We're just over halfway through the year, and again, I got a lot of questions about AI and interest rates and inflation and what all that means and what's going to happen. So let's talk about this. These were kind of the common themes that came through and that we've heard a lot from clients in our meetings too. What I think, this positive, not painless. Like, I think we're going to be positive, by the end of the year. We're already positive for the year, but continue to be positive throughout the rest of this year. But not painless means, it's not going to go in a straight line. It's very common to see volatility pick up. We've already had some earlier this year, back in March, April. But also we are in a midterm year, and it's common to see more volatility. We're also going to see more and more of the AI, boom, I guess, as you would say, but also the impact that that's having, and our companies achieving a return on what they have been investing, because companies have been investing in AI for some time now. It's not a brand new thing, and we'll see our companies announcing that AI is the investment they're making in it, is it generating a return on that investment? And then 2, we'll get more and more inflation data, because inflation data comes out all the time, and we'll get the meeting minutes from the Federal Reserve. We'll hear from the Federal Reserve. Of course, they meet several times between now and the end of the year. And what are they going to do with interest rates, and how is inflation helping or hurting their view on interest rates? So what we've got, the economy's still expanding. You saw my economic charts there. That is true. Economy's expanding, and AI is really turning into a big investment theme, not just, for individuals investing in stocks, but I mean, companies are committing a lot of money to AI. And that gets spread out in a lot of areas too. It's not just a few winners. Earnings have been phenomenal, and really, that's justifying how the market's performing. But that doesn't mean there's not risks. Again, inflation is it's not going away. We'll never not see inflation, but it's not low enough to where the Federal Reserve is comfortable yet. So let's talk through everything. We had some of those geopolitical shocks with the war in Iran. Oil spiked. It has a barrel of oil has come down. It hasn't necessarily come down as much at the gas pumps, but a barrel of oil has come down. Interest rates have gone down. They've gone up, and that has created some volatility in bond prices and yields. But profits, earnings have been great. Margins, like corporations, their profit margins are phenomenal. But inflation is again, it's not slowing down. It's continuing to be a thing. It's not runaway. It's not like what we saw during 2022 post-COVID, but it is higher than I think most people would like. And then the other thing, another positive is that it's not just a few stocks driving this market. Sometimes we talk through that where it's the Mag 7 or the top 10 stocks, or in terms of like size, are driving the majority of the market. That's not true. It's spreading out. I mean, I showed that the market chart that I showed at the very beginning. The Russell 2000 is the best performer. That's 2,000 companies, and they're much smaller companies. They're performing better than the biggest companies. So here's some of the economic data here. So this first graph, this is two ISM, this is Institute of Supply Management. They survey businesses, the very widely followed survey, very good. And they have a metric. What they look at is anything above 50. So this black line here in the middle of the chart, anything above that line is considered companies are in expansion mode. The orange line is the services survey, and the purple is the manufacturing survey. Manufacturing is a much smaller piece of the economy, relative, in terms of size and jobs and everything else. And with all the tariffs and everything, that definitely was holding it back. That has since changed. Both of them in expansion territory, doing well. This is a different chart, but a jobs market chart. So this is initial claims. So the other was continued claims. So people who are continuing to claim unemployment. This is when people first get laid off and file for unemployment. And you can see there's a lot of noise in this sometimes. But it's been trending down. You just look at the trend here. That trend, if we were to draw a line, that's been trending down. What would make us nervous if we start to see sustained spikes in this and definitely start to get closer to the 300,000 level. We're now at 187,000. If we see these surveys and they get closer and closer to 50, but again, stay down there, not just a 1 month and go right back up, because that's more noise. And then if the unemployment rate stays above 4.5% for a sustained period of time, and maybe even continues to get worse, that would be a red flag. Not seeing that, it's just those are things that we're monitoring. Well, let me talk about AI. So this is what that graph, that economic business spend under the economy charts I showed, business spending and how it's just been spiking. It's a lot of it is this capital expenditures that businesses are doing with AI. These are, these big tech companies. You got Microsoft, Alphabet or Google, Amazon, Meta, which is Facebook, and then Oracle. Going back to 2019, this is how much they were spending on CapEx and, the AI related CapEx. So capital expenditures, a lot of money, but these are billions of dollars, but just look at what it's done. 2025, 412 billion. And then last year, in 2025, these companies estimated they'd spend 473 billion CapEx on AI. It's actually now 741 billion because they just keep increasing what they're spending. And then now $889 billion for 2027. That's crazy to think about how much these companies, and these are just these companies, not to, that doesn't include the rest of all the stocks that are traded in the stock market, and then 2, private businesses. Nearly 2.5% of GDP, and 4 times what was spent in 2023. I mean, and that's just the estimate for 2026. And why this has really been driving stock prices so much is because, well, one, it doesn't just go from, okay, Microsoft is spending it on AI and it just ends up being chips or computer equipment. I mean, there's a lot of ways that gets split up, and it shows up as revenue for other companies. So this is the business spending piece. Again, it's not nearly as big as the consumer, but it is large and it's growing. And let's put this in context too. We call those companies, the hyperscalers. These are the big companies spending money on AI. Microsoft, Amazon, Google, Facebook, Meta, Oracle, again, those are the big hyperscalers. 2025 and 2026, it's looking like they're going to spend over $1 trillion between those 2 years. And then the AI pipeline, almost $3 trillion of what they're talking about spending. It hasn't been spent yet. That's just announced capital, but that's a lot of money. So just, these are various like government things like stimulus packages, the Inflation Reduction Act, $900 billion. Stimulus in 2009, $831 billion. The TARP, which was in the October, November of 2008, when we were in the great financial crisis and at the worst periods of it, $700 billion. What they are spending is phenomenal. And the important piece is it's not increasing the government debt like all these other ones did. It's not financed by the taxpayers. businesses are committing to. Now, yes, I'm sure in some cases there's some, maybe some tax at the local level that's getting, trying to attract certain things, that they're waiving certain taxes, but it's not showing up in the national deficit. We'll put it that way. So where does it show up? Okay, so these hyperscalers, they spend the money, they buy chips and memory. Those go into data centers and networks. And then there's the whole thing with building the data centers, which, not everyone's in favor of. I totally understand that. You've got then the power side of it and the cooling side of it too. Construction, we deal with a lot of engineers, and they have a lot of projects related to these things. And those all show up in, again, revenue, profit margins, and then ultimately in earnings. But you can kind of see it doesn't just end at that first spend. It keeps flowing through. And the engineering companies that we work with, they're all private, and they're benefiting from this. I mean, a lot of people are benefiting from this, not just tech. You've got industrial companies, utilities. I mean, utilities have been performing really well. Energy companies too. Of course, the material side, companies that are providing the inputs into these projects. And then communication services. So these are the networks. Again, it goes a lot of different ways. But it does have to, earn a return. So that's one of the things, we haven't seen, there hasn't necessarily been enough time to see the results of that yet. I think we're going to get closer and closer to companies having to report on how that AI spend is going. Are they seeing economic benefits from it to justify the spend? This is earnings growth. So I showed the earnings estimates. What this is showing is the quarter-to-quarter growth in earnings. You could just see these, look at these percentages down here. Now, these are coming out of COVID, so earnings was pretty bad. So the year-over-year, quarter-over-quarter, those growth numbers are coming off a low base, so to speak. Well, earnings have been good, and now we're seeing Q1 almost 29%, Q2 38% earnings. I mean, that's just, it's phenomenal. And then we've got profit margins too. And it's not because companies are laying off people. It's just when earnings picks up this quickly, they aren't necessarily hiring a bunch of people or spending a bunch of people or spending a bunch of money on different long-term projects besides these hyperscalers, because the money is showing up so quickly. Sure, they'll spend it eventually, but it's just been a good recipe for what the stock market has been experiencing lately. But if this gets built into, companies are forecasting, this is gonna continue this way, and they're maybe overly optimistic, that can lead to more disappointments in the future. Not saying that that's what's happening. It's just companies have to be cautious with, hey, is this going to last? Is this going to stick? Or do we need to be cautious? Because it's great. You got a bunch of cash today. You might have a bunch of projects in the hopper, and it looks really good, but let's let those things play out first before we start getting ahead of ourselves. Talking about the how this spreads through the market, and it isn't just the big tech companies that are benefiting. So this orange line This is the price change since the beginning of the year of the S&P 500. Up 8.6%. The blue line or purple line is also the S&P 500, but it takes it a step further. So the way the S&P 500 is constructed is it's weighted by a company's market capitalization, which is just another way of saying its size. So the larger the company, the higher weighting it has within the benchmark or within the S&P 500. They're not all equal. Like the top 10 companies in the S&P 500, I think, make up 30% of the weighting, for example. So what this purple line does says, well, what if, and you can actually invest in this, not saying you should, but you can. What if you just weighted all 500 companies equally? So got rid of that market cap weighting and just did an equal weighting. So what that means is that the top 10 companies have less of an impact on the overall return of the S&P 500. They all have the same impact. So smaller companies get, you know, their performance shows up more in this purple index. This is the equal weight S&P 500. This year, it's almost up double, not quite, but which tells us that more of the returns this year are coming from the rest of the market than they are from the top, you know, the top 10 companies or the top largest companies. Not always the case, you know, but that's been the story this year. And that's a good sign. More and more companies are performing well. And the consumer is still doing good. You know, we have jobs. Wages have been going up. They've been, for the most part, keeping up with inflation. There's a significant amount of equity in people's homes. I mean, this is almost $35 trillion equity in people's homes. Going back to 2018, 2019, you see that number, it was hovering around 18 trillion. It's nearly doubled since then. And this graph here on the right side. So this is how much as a percentage, this is called debt service. So what percentage of people's disposable income, so that's, you know, that's spendable dollars after taxes and everything, kind of what hits the bank account. What percentage are people spending on their mortgage and other, you know, debt they have? 11.3%. You can see that number's been going up, still below the 2007 peak that we had. And that's part of the reason why there's a lot of talk about the Fed and interest rates, because that would make this number better. If people could refinance into lower, lower rates for mortgages and other things, that would make their debt service less. But it's not, you know, it's not high from a historical standpoint. We'll put it that way. Still manageable. And this equity is a big thing too, because that just shows you what you're spending as a percentage of your income. It doesn't show you, your entire net worth. And this is what this is. This is, you know, because there's a lot of talk about, well, this K-shaped economy and it's only benefiting the ultra wealthy. And not to say that's not, the ultra wealthy aren't benefiting, but the bottom 80%, so this is what this looks at is by income. So the top 20% of income earners, this is how much their net worth has grown since the end of Q4 2019. $48 trillion. The top 20%. And then the bottom 80%, because, you know, again, a lot of the headlines and a lot of the analysis would make you think that the bottom 80% or even, you know, people aren't participating, and that's not true. Sure, it's not at the same level, but their net worth is growing too. So again, I think the consumer is in a really good spot. Inflation, one of the biggest risks that are out there is if it doesn't slow down and or get worse. I think the bigger risk is if it gets worse, because then the Fed has to keep interest rates high, potentially raise them higher than even the market's expecting, which, you know, does impact how much things cost, impact what people have to pay for mortgages. If they are moving or looking to buy a new home, that increases those. Then you have auto loans and things like that. I mean, everything kind of, all prices tend to go up when interest rates are higher. So this is all the different components that kind of go into the inflation calculation of CPI, which is commonly quoted. You know, government tracks that. You can see the different components. Now, the last 3-4 months, a lot of that growth has been in energy, because, you know, energy isn't always a big driver of inflation, but when it does pick up, it tends to pick up fast, but it also can decrease quickly too. You know, this is going back to 2018, and then here in the middle, we've got post-COVID, and when we have that high inflation numbers, you can see that in the green, that's all energy. And then energy, it'll bring inflation numbers down too when energy prices when they drop quickly. You can see how the different components are impacting that. Yeah, it would be, you know, nice to get into the sub 3% range. I think that would be what the Fed is looking for, to potentially keep rates the same, if not lower, over the next 12 months. This is that interest rate chart I showed before. You know, 1 to 2 hikes. We get, you know, once we hit 2, though, that does start to increase the odds of another one. You know, priced in those 1 to 2 hikes, we start to get, again, 2. That would be a thing the market's not going to like. It's going to be a, you know, a surprise. Again, earlier this week, they kept rates the same, so that was a good sign that we're still on that path. And as I said, the returns aren't going to come in a straight line. We have a midterm election year, and it's very common to see pullbacks in any year. I mean, on average, you've got a 14% pullback any year, meaning from the market peak to when it bottoms and starts to go back up again intra-year. So by the end of the year, you might have a positive return. I mean, you have that 75% of the time, but intra-year returns don't. If you just were to take a snapshot at the low point, you might say, well, we're down for the year. But by the end of the year, generally up. And those returns can come in spurts too. I've seen years where all the return for the entire year came in the last 6 weeks. It doesn't just, you know, if you make 12% a year, it doesn't come at 1% a month. Midterm election years tend to have more volatility than the other 3 years of a presidential cycle. And the lows commonly come in August, September as we get closer and closer to those elections. Not saying that's going to happen this year. Right now, we haven't seen signs of it. Generally, we have weakness throughout the summer. Now, we've had a little bit here in July, but we're also coming off an exceptionally strong Q2 in terms of performance. But I think the other important piece to this, because a lot of times we talk about that, what's the downside, the potential downside? Well, if the markets can fall 17.5% in a midterm year, you also have to look at, okay, well, after that happens, what typically happens after that? In the 12 months that followed that low, and again, this is going back to 1950, so it's looking at a lot of election cycles and a lot of different data points. So each individual election cycle is going to be different. These are averages. But after that low was achieved, on average, the next 12 months, the market was up almost 32%. So that's why we always talk about that volatility, especially the downside volatility. And those market pullbacks, those are opportunities. Because if you're diversified, they all recover. It's when you're not diversified, you got too much invested in one sector, one industry, one company. Industries and sectors can, a little bit more diversified, but sometimes they take a long time to recover, even though the rest of the market is doing well. And individual companies can go bankrupt. It's the power of diversification. So far this year, we've had a drawdown of just over 9%. And again, that volatility is normal. Going back to 1928, on average, there's a 3% dip 7 times each year. At least one 10% correction. Every 2 years, a 15% correction. Every 3.5 years, a 20%. They call that a bear market. 20%. I don't know who came up with those. I'm sure we can find that information out if we really are curious about it, but volatility is normal. Not something to be scared of. So here's what we're watching. So growth, economic growth still expanding. What would, again, make us more cautious? Starting to see weakness in both the service and manufacturing sectors. Initial jobless claims start to creep up. That most recent data point, 187,000, we start to get closer to 300,000 on a sustained, basis, not just one data point. Higher unemployment, that would get us a little bit more cautious about our outlook and our positioning within the portfolios. Inflation is not in crisis mode yet, but if we see, again, continued data on CPI, all the inflation releases from the government, those don't start to improve or actually get worse, then I think we're going to see the Fed raise rates. Right now, they're indicating maintaining, again, 1 to 2 hikes. Markets start to expect more than that. That becomes more of a cautious, especially for those interest rate sensitive areas. AI, the spending that's going on with that is a significant tailwind currently, and it's projected to be. But if we don't see, if companies are indicating they're not receiving the return on investment, that pipeline will also start to dry up, which will be it'll impact a lot of other companies too, who could have been adjusting their outlooks and everything else based on what they thought was in the pipeline. then credit. So, this is the ability for companies to get credit quality. So if companies are starting to default, not just public company, if we start to see defaults across consumers and even private credits, that would be another red flag. I mean, we're some consumer areas, you're starting to see a few defaults, but it's not in crisis mode yet. Now, I always like to talk about kind of where we've been. So we were in Q2 2026, a over 10% return for the quarter. And that doesn't happen that often. This is going back to 1950. On the right here, the chart. All the Q2s that had over a 10% return. You can see them listed here. That's the end of Q2 for that year. And then what's plotted here is then what was the return for the next quarter following, because a lot of times you might think, well, if Q2 was strong like that, well, then the next quarter could be poor. And then let's look at the quarter after that. Then let's look at, the 6-month total return following the end of Q2. Almost 89% of the time, Q3 is positive. Median 7%. 100% of the time, Q4 is positive. Median 5.5%. Gives us the final 6 months of median return 10.8 with a positive almost 89% of the time versus all years. So that's what the bottom of this shows. Q3, Q4, and then final 6 months of the year. So, these aren't necessarily set in stone because anything can happen. But there's only been one Q3 lower since 1950, 0 Q4s that were lower, median 10.8, average 11.7. And what this is pointing out is just when a market's trending higher, it tends to continue to trend higher. And don't be scared of the volatility. Earnings have to continue to show up. I think inflation is going to be a key component to how things are going to shape up. Now, if earnings are strong but inflation's still high, and if the Fed hasn't significantly changed interest rates, yes, that maybe they are indicating more than the 2%. We can still see positive markets because you got more positives than negatives. Just pointing out all the different various things. And it's the combination when everything starts to go wrong, well, then that's usually when we're probably headed for a recession and we might see even a more significant pullback. As long, the really important one is earnings. If earnings are there, and if the job market stays, even if it just trends sideways, as long as it doesn't go negative and get worse, I think we're going to continue to see strong returns throughout the rest of this year. Again, it's not going to be without volatility. It won't be in a straight line, but as long as we're diversified and we have a plan, which we all do, we can get through it all. Well, thank you all for watching today's webinar. Appreciate all the questions that you all submitted. And even questions that you provided throughout the webinar. Stay tuned for our next episode of Keen on Retirement podcast, because we will be addressing any questions that I didn't cover or any questions that were submitted during the webinar. And for those of you that maybe this is one of your first webinars, check us out, keenwealthadvisors.com. You can go to Retirement Resources, subscribe to get all the updates for future podcasts, blog, and webinars. If anyone watching this too would like a copy of the second edition of Mr. Keen's Amazon best-selling book, Keen on Retirement, Engineering the Second Half of Your Life. Please email me, mwilson@keenwealthadvisors.com, or just reply to any email that you receive from us, and we will get a copy sent your way. And then lastly, all of our podcasts, we are recording the video version. So we have the audio version, but the video is on YouTube. Getting lots of comments from clients who like to watch the YouTube channel. You can find us youtube.com @Keen Wealth Advisors. Podcast episodes, webinar episodes, and lots of other great content out there. Again, thank you all for watching today, and we will see you next month.